have mail.
Good. Great. So if you would like to send mail, send it to Doug@riskingroadtv.org, and I'd be happy to answer your questions. What do we have this week?
Okay, this is from Steve in Redwood City.
Thank you, Steve.
He says, I really don't trust the stock market. It feels like the game is rigged and only there for the insiders. If so, where should I put my money? Real estate? Question mark.
Right. Well, good question, Steve. A lot of people feel the game's a little bit rigged. You know, the high-frequency traders that are in microseconds, you're never going to be able to do that, so they're getting you an edge. The hedge funds that are moving the market around and have all kinds of inside information, possibly inside information, that makes you feel like the game is unfair. And if it's unfair, you probably don't trust it. But there's another way to think about trust, is whether you trust putting your money in the market that it'll go up. So there's two types of trust there. Both of those games are very similar in real estate. They have they're not the same exact risk, but they have the same unfair advantages in real estate. You don't know what you're really buying in a house. The person selling it to you knows stuff that they're not telling you. They're supposed to disclose it, but do they really? Are you really getting the best deal from the realtor? Are you really, these are all the same problems that you have in stocks. So you're buying things, there's risk involved. In fact, that's why we call it Risking Reward TV.
Yes, it is.
That's right. So if you want a reward, you're going to have to take some risk, and that's true of stocks or real estate. So when you think about this, what you should do, if you don't like any of the markets, you want to find a way that's a little safer, diversify. Put some money into real estate if you have enough money to buy some real estate or invest in real estate. And then, of course, you can buy some stocks. But now when you think about stocks, don't think about the stock market. Think about individual companies. Because although it's okay to trade stocks, lots of people do, it's also okay to just buy parts of companies. Now, they issue them in shares, which are stocks, but you can buy a piece of a company. So you buy an itty-bitty little piece of a company, say McDonald's. Well, if you own McDonald's, what do you own?
You own a global franchise company.
That's right. And you own real estate all over the world. Speaking of real estate, they own the land. They have great pieces of property all over the world they own. They own the dirt. They lease the building, they lease the franchise to the owner for, I think it's 20 years with McDonald's, I forget. But at the end of 20 years, they lease it to another guy, or they release it to you. And if McDonald's burgers go out of fashion, they can go to salads, and they can go to this, and they can go to that. Is food going to go out of fashion?
No.
Is convenient food going to go out of fashion?
No.
No. Is good locations that a lot of people walk by every day going to go out of fashion?
No.
No. So you're not trading stocks. You're buying the future cash flow of all these little outlets. And if you buy it at a decent price, you're not trading in the stock market. You're investing in a company. And that's a different way to look at it. So instead of worrying about high-frequency trading, which doesn't really matter, you're just worried about the cash flow from McDonald's. This is more along the lines of what Warren Buffett does versus what hedge fund managers do.
And what is your takeaway?
So my takeaway is the pros in any game typically beat the novices. So don't play their game. So what you should do with your money depends on your need for return, your ability to take risk, and your desire to take on that risk. Answer those questions first, and then look at the investment opportunities that meet your personal criteria and diversify across them. It's not playing a game, it's about making smart decisions on your own situation.